cost is these are the steps. One is so there could be separate scenarios of property plant equipment purchase, separate acquisitions. It could be self-constructed assets. So we buy separate acquisition means we just buy in standalone equipment. Like for example, we buy a laptop. That's done. Self-constructed assets. It could be any machine which you are building in-house, software, but that's an intangible asset, or a building which you are constructed in-house. It could be or it could be anything else physically which we are constructed in-house, or we are in a factory of furniture, right? And we are using some of the furniture in our office. So that was the self-constructed asset. So how we going to use that? If multiple assets are acquired in one single time, if acquisition is through the government grants, and if there is an exchange of assets. So we are going to now discuss these five different scenarios, management of measurement for the cost measurement in five different things. So the self-constructed separate acquisition of cost is simple. We just have to have the purchase cost plus non-refundable taxes minus the trade discount, and we are going to add. We normally don't want to add any other overheads, but there are certain direct cost, like the cost of transportation, cost of the import duties. We can add those to the assets. Overheads we are not going to add. We need to still adjust the dismantling and the site restoration cost if they are contractive obligation, not constructive obligations. If they are contractual obligations, we have to add into the cost of property, plant, and equipment. Then there are can be another scenario. The other scenario is the self-generated assets. So what are the costs we are going to include in cost? These will be the materials that we are consuming in production of these assets. There could be labor, wages, and salaries to the staff, but only those which are directly used in the production. So not like say there is there are times used by the finance staff to go and purchase the material. Purchasing staff is going to buy the material, or there is an accountant who is recording the assets, the cost. So those costs are not included in the labor cost, labor wages, and salary to staff. Only those who are directly allocated to that particular project will be considered for the inclusion in the cost. And then there's a professional fee for architect or designer who is going to design the equipment, or or the mechanical engineers or plumbing engineers who are advising on these kind of assets purchase or asset construction will be added. Legal fee for registration will be added. Other direct cost will be also added. Trial runs, if it's required by the regulation to have a trial run before we are able to use the asset, has to be added. Sometimes this is industry practice. It may not be a legal requirement, but it's an industry practice. Let's say you are constructing a boiler. So you have a design, you have done a plumbing by yourself, you bought the materials, constructed your own boiler in the property. Even though it may not be sometimes it can be a requirement from the government to have a test run, trial run, do the certification and test of the asset, because it could be a fire hazard to the submission to government. Then the cost of that trial run is going to be added to the financial picture. If there is no legal requirement, it could be an industry requirement that normally for these kind of big assets, there is always a trial run, there is always a certification, and then only the asset is put to use. Then that again, in that scenario, the cost will be added to the cost of the assets. But if there is no requirement, for no industry requirement, no there's just a management that they want to test the equipment, then that cost is going to be not required, not going to be added into the cost of furniture fixture equipment, unless that cost is significant. And the estimated cost of disposal, dismantling, removal of, and site restoration again has to be added. If it's a contractual requirement, if it's not a contractual requirement, then you don't need to add it. Then there are self-generated assets. What we are going to exclude from the self-generated assets, the cost of launching the new products and services, we are going to exclude. The cost of introducing a new facility or venturing into a new market or selling and distribution cost or the administration cost. These costs we are not going to add into any kind of property, plant and equipment. These costs usually are used for the, let's say we are launching a new factory, so there is a sales and marketing cost, or there is a market research cost to go into that particular market. If we are adding a new machine, or we are going to add a new facility, production facility in any market, so those costs are actually not the cost of property, plant and equipment. They are more on a pre-opening cost for a business or setup cost of the business that could be separated separately, not in the property, plant and equipment, but as a deferred cost which you can use to amortize over a period of time, let's say 2 year or 3 year, depending on management judgment. But the those costs will not be added to the property, plant and equipment. And the another scenario could be the multiple assets which we are acquiring in the single transaction. So if let's say we know the value of separate assets, then it's better and good, right? No problem in that. But if we don't know, let's say we go and buy in bulk from a business, or we buy the whole building for a lump sum price, let's say $1 million. Now that building may include furniture fixture, may include equipments, may include the building part, may include other interiors which have a different life of the asset, so have to be recognized separately. Now in that case, what we do is we would look at the fair value of the individual assets and compare against the consolidated price. If the consolidated price is more than the fair value, then that amount will be look as a goodwill. If the fair value is more, then you will just allocate the consolidated price in the same proportion to the fair value. So that's a simple concept. Then there could be exchange of assets for non-material transactions. So exchange should be measured at the fair value. So fair value in the business, in the market. Let's say if you go and sell in the market, what the value, what value you will get for your asset, and what value you will get for the others asset. So for us, because we are exchanging our asset, so the fair value of our asset which we are giving away need will be the value of the new asset that we are purchasing. So we have to use that, unless there is no commercial substance or it cannot be reliably measured, because the asset has already been depreciated or is not in the fashion anymore, and we are just trading it as a free, right? So then in that case it will not be used. The fair market value cannot be used. Then the if you are acquiring the assets through the government grant, then there is another accounting standard for government grants which deals with it. But in overall, the government grant should be recognized as a deferred government grant, which can be credited to the profit and loss account, and the total value of the asset can be recognized uh, in the accounting standard. In the property, plant and equipment, and depreciation can be charged, and the equivalent amount for the government grant will also go to the profit and loss. So it will knock off the total cost that is charged to the profit and loss statement. So that's the cost measurement for acquisition through the government grants.